Hello, everybody. Welcome, welcome. It's good to see Ryan here because he's first up.
Oh, good.
But welcome, everybody, to this Memorial Day weekend alternative investing club. We'll wait for just a few more minutes to let people in. And while we're doing that, maybe I'll just share my screen here. All right. So we've got a basic brand new website here. And I'm excited to be sharing this because this is where all of our activities are going to be posted, up and coming. It's at alternativeinvestingclub.com. And hopefully soon the .net will work as well. The DNS is probably updating right now. So we've got a new web page, a fresh new look, some information about commercial real estate, short-term rental, oil and gas, other passive strategies, as well as the schedule of speakers. So you can always come and find out what is happening this current week and what's happening in upcoming weeks. So in the upcoming weeks, next week, we have another oil and gas drilling partnership. After that, we've got a very high profile person that Ashish helped us connect with, Eric Rosenfeld. He is going to be, he's well known in the Oregon venture fund area. And so he's going to come in and talk to us about lessons and trends from the past 17 years of venture investing. And then we're going to have Karen Hall coming in with supercharging your retirement with alternative assets. So, and of course, we've got the Speakers Hall of Fame. Not all the videos are posted here yet. In fact, we're only doing the last 7 currently. There'll be more coming up there very shortly. Probably in order to get access to quite a few of them, including all the personal information for contacting them, we're going to put it behind a login screen, just so people aren't, taking their email addresses and abusing them directly off the web. So that's all here. Coming up fairly soon as well, we're going to have a chat room so people can post in forums, so people can post about their deals and bring up topics that are of interest to them. I've had a couple of people here recently. And in fact, I had one person contact me, and hopefully you're here, from Arizona. And he contacted me because he was looking for a lender to buy a property, and he needed about a $500,000 loan. So if anybody knows a good lender in the Arizona area, shoot me an email and I will send it to him. Or if you're here online, Mr. Arizona person, who I should have looked up whose name that was before, feel free to speak up and give everybody your contact information. But the forums will be a great place to do that in the future. And I just wanted to start off this particular alternative investing club with an article about this young entrepreneur. It's Memorial Day weekend, who started his own business washing tombstones. And he lives in Otsego, Michigan. This young person is out there washing tombstones. He's charging $20 a tombstone, and he works on veterans' tombstones for free. And I thought this was a good article to bring up because this really encapsulates the vision of investing on Main Street and not Wall Street. And that's what a lot of the investments that we bring into this club is about, right? Investing in properties, investing in partnerships, investing through alternative means that aren't necessarily through, Wall Street. And so being able to take control of your own financial destiny, doing something that's a service to your community, and making sure that it's profitable at the same time is a great thing. And I'll send this along here. I don't know anything about this particular website that I got it from, so I don't know if it's got political leanings or not, but it's a good article. I'll post it into the chat room. And with that, our schedule for today, let's open this up, is first, yes.
Quick question. Now that is an interesting article. I'm curious. Are there journals or news sites or what media syndications that you subscribe to kind of see like this sort of opportunities, or like entrepreneurial opportunities? as you
You
say
know,
so.
honestly, a lot of what I subscribe to is I'll subscribe to brokerages. Marcus and Millichap in particular has great multifamily reporting. So if you go over to Marcus and Millichap, and I get, I don't consume a lot of mainstream news, to be honest. I've got a subscription to the Wall Street Journal, and I listen to a couple of podcasts that I like the Creating Wealth Show with Jason Hartman. I listen to George Gammon's show. I listen to the NPR Real Estate show. Marcus and Millichap, if you're looking at researching particular areas in multifamily, has got a great set of reports here that they publish on a constant basis, including perspectives on the debt ceiling and housing and office. Right now, a lot of you've probably heard the crisis going on in office real estate, and it's a big problem right now because the pandemic shifted all of our behavior patterns, and office space is undergoing a change where it's either vacant and incredibly underperforming, or people are buying them out at low rates and converting them to other styles of other uses. So you buy an office building and convert it to an industrial or a storage or some other type of business that is a better and higher use of the property. Yeah, I actually tend to listen to more podcasts than anything else. I've got reading glasses this year and it's bugging me. All right. So with that, we've got several people that are lined up for, it can take 3 to 5 minutes or up to 10 if you really want to, but we have 6 of us here. So first up is Ryan Olsen, then Anita Gage, Glenn Cochran, Don Baddy, Ashish Gupta, and Misi Liu. I hope you're all on the line here. Actually, if you are one of those people, can you just put I'm here in the chat room so that we know you're here? All right, and I'll hand it over to Ryan. Let's hear from the community. What are you guys doing?
All right, thank you, Daniel. So yeah, I just wanted to share some of the impact that this club has had on me over the last few years that we've been running that. So
did you tell me that's what your topic was?
I don't know if that works.
That's fine. Yeah,
I can anyway. I was just going to kind of go through, how I got involved and what I've taken from it and how I've applied some of the things I've learned, and even go into what I hope to do in the future with it. So hopefully it'll be pretty quick. Feel free to stop me at any time. But started engaging and working with Daniel on the club back, it's been, 3 or 4 years ago at this point. I was in the board of the Oregon Next Gen ERG at Intel, and we were going out and finding interesting clubs throughout Intel to bring in and to make sure we had great events and content for everyone in the ERG, and to kind of promote those and almost even sponsor them in a way, as ERGs were Intel company supported and promoted, had budgets and things, and a lot of the clubs are not. And so anyway, we were able to form a good partnership there. And not only that, but real estate investing was something I was interested in from a long time ago and had never really gotten into. And so I started attending every week. Daniel brought amazing content, great speakers in from all different areas. And so I was able to learn a lot about different areas of real estate investment, to the point that, just over a year and a half ago, almost 2 years ago, was able to buy a property out on the Oregon coast with plans to turn it into a short-term rental. So I was able to learn, again, a lot from the people, the speakers that come to this club about various strategies, various information that's useful for that. Now, with that said, as you actually get into it, you find there's a lot of things, you don't know everything until you experience it, and have had some great learnings. And we're still in the process. Once we just to share a little bit about the experience, we bought the property as a second home, so we could get the better better mortgage rates and lower down payment because I didn't have enough to do the full investment property at the time. And so that meant for the first year, we had to use it more than we rented it out. So plus there was a lot of work we had to do on the house. We redid all the floors, we repainted, got all the house furniture set up and everything anyway. Well, about 8 or 9 months into this, the county where we bought it, because when we bought it, there were no restrictions at all on short-term rentals. There are a lot of areas, especially out on the Oregon coast, a lot of cities and areas where you can't do any new short-term rentals. But we were in an unincorporated county just north of Rockaway Beach, and there were no restrictions at all, which is why we went ahead and got it. Well, the county decided last July to put a 1-year moratorium on any new short-term rental licenses, which we're hoping will come up this July. So we're at this point just doing it, promoting it through friends and family, word of mouth, and we still can't go full bore since anyway, there's the whole county licensing issue thing there. But with that being said, it's been a great adventure. And now we do have an asset that we've acquired. And like I said, a lot of it gave me the confidence from what I've learned here in the club. And so then a couple other things that have gotten from this is exposure to a lot of new asset classes that I didn't really even realize were possible to invest in. So everything from short-term rentals, or not short-term rentals, storage units to vineyards to parking lots, like all kinds of things. Plus I've learned a lot of things that I've tried to share with I have 3 boys. My oldest graduated high school last year. He just finished his first year at trade school this year, but shared with them things that I've learned through the club, like house hacking, and then encouraging them to, as they kind of leave home, to start doing those kinds of things to set themselves up in a better place than what I have been in. And then also met a lot of great people like Daniel and Mei and others that are here in the club. And now I know people that as I look to find some opportunities to passively invest, I've got some great options and connections from this club that I plan to pursue in the future. So anyway, that was kind of what I wanted to share. I don't know if there's any questions. Happy to answer any. If not, I'll turn it back over to you, Daniel.
All right. Thank you, Ryan. I would wait just a moment here, see if there are any questions. And hey, if you have had a similar experience to Ryan too, where you got some piece of knowledge from this club and you acted on it, or it gave you the confidence in order to go out and to invest, just put a 1 into the chat right now. I want to see who here has actually taken action because of something that they learned in this club. All right, there it goes. All our speakers.
Well, that's good, right?
Yeah. And there's one other announcement that I failed to mention at the beginning. I am going through all of our back videos right now and creating transcripts of all of the previous meetings. We've got 177 of them now. I would love to have a community effort to help me clean them up and maybe attach timestamps into them at certain locations and get them up on the web page. So if you're interested in helping me out with that, please let me know. All right. Any other feedback for Ryan?
Just want to say great job, Ryan, for taking actions. So it can be nerve-wracking, but you took that step. So good job.
Thank you.
All right, Anita. What do you have for us today? Oh, you're on mute.
All right, can you hear me?
Yes. Well, it's kind of quiet, at least on my end. Is that the?
All right, let me change the audio.
I'm not getting it really well. Is it everybody, or is it just
Yes.
me?
Yeah, same here.
Okay.
Okay, is that a little bit better?
Not really.
No.
Okay, I'm gonna change it to
Anita, it almost sounds like you're
Is that
not
better?
on.
Yes.
That's
Oh,
much
yeah,
better.
yep.
Okay. So hi, you guys. And Daniel, I sent you a quick PowerPoint just to make sure that I don't go long-winded because I can be long-winded sometimes.
Do you want me to find that?
Yeah,
Or-
can you bring it up?
Or you can share it. Sure. It'll
Okay, I
take me a
think
moment
I
to
can
get it.
share. Let me share my screen. All right, can you guys see this?
Yes.
Yes.
All right, let me make it full screen. It's been a while since I've been at Intel, but hopefully I can remember how to do this stuff. All right, is that better?
Yeah, looks fine.
Yes,
Okay.
it's good.
So Daniel asked for me to come in with my my good experiences and learnings. So the first thing I'd say is there's 3 people who have been really instrumental that are companies that have helped me the most. One has been a realtor named Betty Garrity. One has been a property manager named Jim Riley. He is part of the Opulent Real Estate Group. And one has been my alternative advisor, which is Tim Shear. He's part of the Shear Group. So having said that, let me just give a little background on my logic and my strategy for going forward. I always feel that folks always need at least 3 streams of income. I think that's pretty important. So, you know, I think we started off through Intel, that's our W-2, that's one income stream. And if you only have that, you should always have like a couple others because you never know when your plan B becomes your plan A. So the second goal for me that I hold pretty important is that even though you might make money, the goal is making sure that it's passive, which means you don't have to do a lot of work for it. And it's also tax free because as you get more income, it becomes a hassle when it comes to taxes. So there's my just to be totally transparent, my main 3 income streams are stocks. I do a lot of option selling and I do puts. They've been great. Real estate, which we'll talk to in a minute because that's why I'm here. And then also syndications. There's so many categories. This has been really good for tax minimization and cash flow. So my logic for getting started in real estate was, and this is like early 2000s, right? I buy 2 places. I would hold it for a little bit. I'd sell one, pay off the first one, and then I'd have a free house. So that was in my mind, that's how I thought it would work. And then I just repeat. So I'd always buy like 1 and 2 and 3 and 4 and 5 and 6. And I started in Phoenix back in the olden days. It actually worked. It was fun because places in Phoenix are really, really cheap. So I was just doing it because that's what my mentor told me. And then after I started accumulating a lot of properties, I realized it was hard to manage properties and work at Intel. So that's where the finding the good property manager came in. A good property manager is worth their weight in gold. So then after you start, making money, you start thinking, you know what, I'm getting taxed off the yin yang, and some of the stuff I can't necessarily write off. So then I had to learn to like minimize taxes and figure out how to hide taxes. And I will say that real estate is one of the best ways to kind of minimize your taxes. I can go on in detail about that, but I think those who are really deep into real estate, they definitely understand that part. And then once I got that, I started doing that, I went into the alternative realm. And that's where you get into syndications and stuff like that. And since this group is called Real Estate Alternatives, I think, it's pretty appropriate to make sure we learn about that stuff. Okay, so last slide. Who are the people and why? You can tell I just use a can slide, so just ignore the title and content layout. So these are the 3 people I talked about. I talked about their role. So the help that each one gave me. So Betty, she taught me the ropes on how to buy rental properties. She was a mentor even before I knew I needed a mentor, because I never really walked up to her and asked her to mentor me. I saw her at an open house. We start talking and I was like, I want to learn how to buy real estate and do all this stuff. And she's like, okay. And she just took me under her wing. And I just remember going out with her, looking at homes or looking at signs. and we don't have any appointments. We're driving through neighborhoods, we're looking at the sign, and before you know it, we're sitting in a person's living room having coffee with the potential seller and making friends with them. So every property that I went in to get, I was able to buy because of the relationship. She taught me how to build. So she was really valuable when it came to that. I cringe sometimes when she just would knock on a door and make friends with people. I don't know if that works now, but she was amazing at that. So I loved her because she was a very valuable mentor. And I thought that was pretty good. So my learning with Baddy was that the hardest part of the real estate thing was just getting started. I was scared. I didn't have people to ask. Nobody in my family really did it. So, I realized it's not that hard at all. If you partner with somebody who's doing it, they show you the ropes, and it's been amazing. For Jim Ruley, he was getting started with his property management stuff back in the day, and I was one of his first people. So I had been through a lot of property managers, and I didn't really know a lot about interviewing a lot of the property managers and asking them questions. I just figured, how much do you charge? They tell me 10%, and I would just accept that. But then as I started going through property managers, when they didn't do what I wanted them to do, I realized, wait, I'm the one paying them and I should be in charge. And I realized I don't want to pay you a percentage. Like some people charge 10%, 7% on $1,500, on a $1,500 rent, that's over $100. And it doesn't matter whether the house is big, the house is small, you should, you don't have to do any more work. So for him, he was charging a flat 65, 70 bucks per house, regardless of the house. So that was cool. I learned he was very cost effective. And the other most important thing is he answered his phone. And as a property manager, that's what you want somebody to do. So from him, I realized I'm not cut out to be a property manager. And if you get a good property manager, that's valuable. Tim Shear is the last one, advisor. He's the one who helped me move from, from being taxed in a lot of buckets. He helped me move into a passive tax-free position. So Tim he's always been bringing me new deals that he vets. These are syndication deals. They usually come with a dinner, which I like to eat, for those who know me. But I have a friend here, she's laughing. He pretty much taught me how to do a lot of the taking tax deferred investments and creating, moving them into Roth at a reduced cost. So I think that was pretty important. So my learning there was income streams, they're strategic. So you just don't go out and say, hey, I'm gonna buy this. You got to have your in mind. So that's it.
All right, awesome. Thank you, Anita.
Sure.
Any questions for Anita?
Yeah, I have a question, Anita.
Sure.
I actually don't know that many. I actually looked up on this Shear group. Their website looks interesting. I don't know that many alternative advisors. Mm-hmm. So how was that experience? I see that he's well versed in from equity market to private equity to insurance and etc. So how are you liking it, and how are his certifications? I'm just curious because I haven't heard much about that before.
So the experience was like drinking from a fire hose. My eyes was like, I was like, where did all these, come from? Because I just realized really a syndication is just a bunch of people pulling their money together for leverage to buy different things. But there's a way of doing it. You got to do it, legally. You got to make sure you send out PPMs, private placement memorandas. You got to make sure that, the risks and stuff are exposed. So I learned a lot about the legal way of pooling your money. And I learned a little bit about, all the different ways people do it. And when you get into the syndication realm, I learned that there's a lot of people out there, but like the good ones, they all know each other. And, they all work together and they all do the fundraise kind of together. So for Shear, like he works with other people. And if say somebody's raising, I don't know, say $50 million for something, they might break off Shear, the Shear group, $20 million and have him go off and raise it. And he has his group there's like a group of people here. He probably has, I don't know, 500 folks underneath his management that he'll bring these deals to get preferred rates. So I think it was good because I learned a lot about a lot of different, opportunities. And just learning that they existed and learning like how to vet a good sponsor and what kind of questions to ask. And when you start vetting these things, you want to know like what's the duration of your hold for your money? What's the not just what's the return on your money, but what's the risk? Like there's an apartment complex, a student housing in Berkeley, and I was trying to figure out like that should be great, but there actually are a lot of risks. That's not a great investment. So just things like that, you learn how to vet them. So that's what I would say.
All
Thank you.
right.
Any other
And
questions?
I have one question for Anita.
Sure.
Anita, hi, it's Thornton.
Hey,
Have you written your own syndications before?
I thought about that, but that's too much work. And I'm moving into the passive realm. There's so many people who raise money for their own. I like to be the shark. I don't want to be the guppy that they eat. So I want to make sure that I have the option and I have the choice, and I can just look at theirs and say, yeah, I'll do that, or no, I won't do that. So it's a better position to be in. But it's also, the sponsors, they're making a lot more money than I am, but I'm happy making 10, 15, 20%.
are you thinking about putting together your own syndication, Thornton?
At some point.
Yeah.
Yeah.
Well, Misi and I both have a fair amount of experience doing that. If you want to book a call with one of us.
Okay. All right.
Yeah.
Thanks.
Yeah.
Okay. Let's
quick
get
question.
on to the next speaker. I'm sorry, we're gonna have to go to the next speaker because otherwise we're not gonna get through them all. But feel free to put your question in the chat. I'm sure Nita would respond to it.
I will.
Glenn, you're next.
Okay. Hopefully I think I'm sharing. Yeah, I got a thumbs up. Good. All right. So, great. So let's see. So what's my journey on real estate? Okay, there it goes. Okay. So I used to live up near Seattle. And I started buying single family homes and duplexes around 2000. And I'm a DIYer at heart. So learned as soon as I got my first job at Intel right out of college, how to go swing hammers and visit Home Depot and buy a pickup truck and all the things necessary to sort of, fix my own stuff, and said, well, geez, just like Anita described on the gold value of a property manager, I thought they were all evil. And so I said, I can do it all myself. I don't mind fixing toilets. I don't mind swinging hammers. So I'll do that. I got a job move, which put me in Phoenix in 2004, but my property was sitting back in Washington. It makes the problem of fixing the 2 a.m. toilet a little more difficult if I'm that far away. I went through the same experience I think she did with going through a bunch of property managers. Trying to vet them remotely was even worse, and not having a good network of reliable contacts also kind of inhibited. I eventually exited the Washington markets and properties, and sold them off, and then right around the housing crash, I decided to take the opportunity to go buy into a new house, and then took my old house and rented it out for many years, continuing to fix toilets and everything, but ultimately realizing that I wanted to go have more property ownership. Intel was taking more and more of my day, and I don't have a scalability solution. Prices were high enough that it still also became a problem of having things pencil if you put a property manager in the income level, or sorry, taking their cut out of your rental income. So that became even more problematic for trying to find stuff. So I went on a hiatus for a little while and thought back about what am I trying to do and why. And over the last 15 years, a lot's changed. I'm getting a lot older. I'm thinking a lot more about what retirement looks like. And so for me, the idea originally of being able to do appreciation 20 years ago is not the same necessarily goal I have right now. What I wanted to do is I wanted to say at some point, give Intel the middle finger and have a W-2 replacement for my income stream, have some sort of passive income model. So that's where I set my goals, is I wanted to go come up with something that was going to give me that. So appreciation was less of a priority for me, but I wanted to make sure that I wasn't eating away at my assets, so that since I'm using that as a basis to be able to generate income to last through retirement. Okay, so I decided after looking at all the various types of investments, and I sat through this group for probably a good year before I jumped in. I think, as Anita said as well, it was sort of a big step. The biggest one was to get started. Taking that leap, I would agree. I decided commercial real estate is where I wanted to jump in because it gave me everything exactly, no compromises. I give some money, I don't have to do any work. I get these interest payments and I get an equity upside at the end. How could you possibly go wrong? It's fantastic. And I was just going to build a pipeline of these deals to give me the equivalent W-2 level of my income and then just sit back and show me the money. And it was going to be fantastic. So what have I learned along the way? A lot of the commercial real estate syndication type deals will talk about getting a pref, or what I was referring to kind of simply as the interest payments. This is really, really unreliable in my experience for multiple deals. And so the idea of having these income stream style payments coming from a value add commercial real estate type deal was probably my biggest learning. My second one from a taxes, I would reiterate what Anita said. Depreciation is really underutilized. I'm a W-2 employee, so I've got a lot of restrictions there. Also, my investment mix between what's income generating and what's appreciation generating is also a cause for that underutilization. I would say also that I've gotten a lot more cautious in the last year as the interest rates have started to go up. It's pretty clear that there are a lot of deals that are needing to either exit or refinance or whatever, given a lot of them are structured on kind of a 2-year window for the value add part. And when they did their assumptions and how conservative or how aggressive they were in modeling that, it can really change the return assumptions going forward. So that's probably a good learning I have on paying attention to that risk model. And the last one I would say that's inside of what's learned is I sort of had this simple model of just do commercial real estate value adds, and I've got this pipeline. It's all set up. I know exactly how many deals of how much money to get me the interest rates I need, and the quarterly checks will arrive, and it's going to be fantastic until Social Security shows up. I need a more holistic and a rebalanced investment model, again, to sort of Anita's thoughts on the multiple income streams. I'm in the same boat, realizing I need to go be more overt about what mix of what deals I choose to try and do that tax benefit, that as well as a more predictable income stream. Biggest message I would say for everyone that hasn't started yet is start. Time is your friend. The younger you are, don't put everything in one shot. Try a couple of things, learn, take your learnings, adjust, reassess, repeat, and you'll get there.
All right. Any questions for Glenn? All right. Thank you, Glenn. Thanks for sharing.
Yeah, you bet.
All right. And next up, we have, and I moved away from it, we have Don. Welcome to the group. Oh, you're on mute, Don. You're still on mute.
Can't hear you, Don.
It's Skype, not Skype. Zoom's mute.
Okay. Can you hear me now?
Yep.
Yes.
Oh, okay, that's interesting. I'm dialed in on a cell phone because the audio is pretty terrible on the web. But apparently the application still controls the mute through the stream, not through the actual phone. That's a learning. Okay. Well, thanks, guys. I've been on these calls now since they were on the Intel side. Really have enjoyed them immensely. I've gotten a lot out of the different topics. Before I get into my topic, which is regional lender advantages, I'll give you a little bit more about my background. I kind of come to real estate investment as an accidental investor, which I now know through this vehicle and the calls with you, Daniel, is called house hacking. I've bought a few houses. I've never sold any of them. So I started with a duplex, which was my first home. Rented the other side of it, went off to college, and then rented the whole thing. Bought another home here in Portland, where I live now. Wasn't a great market. That was 2008. It was a great time to buy. It was a terrible time to sell. So decided to keep that one as well. Rented that out, and then now we got another home in Portland. And then started to dabble a little bit more in real estate down in New Orleans, which is where I come from originally, and built a couple of houses. There are learnings out of that journey, not the least of which is it's wonderful to actually have a primary residence interest rate versus the interest rate that they'll give you as a real estate investor. So if you can keep those are always gold, which is the house hacking mantra. And hold periods matter in real estate. That is where you get your capital appreciation. And even if you're doing investments, if you're doing fix and flips, or if you're doing construction, I've got real life learnings that the hold periods are just critical, and picking the timing in which you're going to sell. But what I wanted to share is what I learned about lending sources. So let me see if I can share this screen. I've only got one slide. In that journey, we think most folks are familiar with what happened to New Orleans during Hurricane Katrina. Tremendous loss of infrastructure in the city. And so the city, in order to rehab a lot of those single-family homes, multifamily homes, started auctioning off lots for purchase. So my brother and I decided that we were going to buy a couple. He still resides in the city, and we did. Bought a couple and decided to help be part of the rebuilding effort, which was really more the goal. At the same time that we made a little bit of money. What I learned out of that is that it is a little bit harder to find national lenders, the way you would on a primary residence, to do construction loans. And so regional lenders play a great role there. What I learned about regional lending, I teamed up with Gulf Coast Bank down in New Orleans, is that they have a lot of advantages that you might not get out of a national lender. Some of those include they're familiar with and offer construction loans. Your normal bank that you have your mortgage with on your primary often doesn't offer you a construction loan alternative. Like I have Loan Depot now. I've had 6 or 7 different lenders over the years for different homes I've bought. None of them actually offer construction loans, but the regional players do, and they fill that role very well. Relationships. I was intro to the regional lender that we use through our general contractor, but they also have tons of relationships across the GC landscape. And they can tell you which GCs are good to work with and make their time commitments, and which GCs aren't. They can also help you with GCs for rehabs, primary construction, GCs that come to the market with a good lineup of ready and turnkey homes that they can drop on a lot and get up in a certain amount of time, versus those that do custom builds. And depending on what you're trying to do in the market, whether you're doing high income home or mid-tier home, they can point you in the right direction for that. So I found that pretty helpful. They also have a great understanding of market conditions. So in this example in particular, as they redid homes in New Orleans, because it's in a massive floodplain, different locations in New Orleans had different requirements with them on those floodplains. And based on the way you constructed the home, whether it was on pilings, off pilings, on an elevated lot or not, it also had huge implications on what insurance you would have to pay later on, as well as meeting certain road home money requirements where additional dollars would be available to you for construction if you constructed it in a certain way versus not having those dollars available to you. So all of those learnings the regional lender community had, whereas nationals would not. And then there are, of course, operating cost advantages that were on the tail end of those, like the insurance picture that we talked about. Last thing, you can get the regional lenders to do things for you that the national guys sometimes won't do. Like a big one was just pulling comps. And I don't know a lot of the folks online who pull comps out of Renometer if you're getting rental comps, and you may pull comps out of the RMLS. But those lenders have access to RMLS, some of them, just like your real estate agents do. And so they can give you a picture of, based on what you're considering, whether or not that's going to hit some of your business plan goals or not. And that I found also immensely helpful on the second bill that we did. Opportunities, and of course the big one, is you may not get the same kind of rates that you would get out of a national lender. They're going to be a little bit more expensive, but they'll be a little bit more flexible as well. And those preferred rates that you might get out of a national lender can sometimes be really hard to pin down. So we found there were a lot of advantages to regionals. And that was the way we went on the second home that we built as well. A personal learning on this that is less germane to regional versus national versus other sources of income, of money for these sorts of investments, is hold period matters a lot. So we disposed almost immediately after we built the home, within about 6 months. If we'd have held that home for another 2 years, I think the second sale of that home was worth another 50%. So I think this group understands that very well, but that was a learning as well. If you're going to do new construction, pick your exits strategically based on what the forecast is for the area. That's all I got.
All right. Thank you very much, Don. Hey, if you have a lender that you've worked with that you really like, go ahead and put it in the chat. I saw Christian put in Umpqua Bank provides great construction loans in the Pacific Northwest. And thank you, Don. These are really true. The relationships and better understanding of the GCs. These are great advantages of regional lenders. All right. I guess I'll pause for 1 or 2 moments. Any questions for Don? All right, Ashish.
Yeah, hi everybody. This is Ashish. I've been part of the club for a couple of years now. For those of you who know, right, sort of my strategy has been similar to Anita's. Anita, by the way, is one of my mentors. I learned a lot from her. My goal has been, growth is sort of what everybody was focused on, right, for years. I was focused on for years as well. Income is where I started focusing about 10 years ago. Personally, I'm more on the syndicate side, right, where my personal goal is to get about 50 of these going. I've got about 25 of them right now, right, which are just sort of anywhere from mini to fairly big income streams. And then on the tax side, I'd like to come in sometime and do a tax specific session because, as you're saying, the depreciation for passive income is pretty easy. Offsetting W-2 income is more difficult, but it is possible. So the last time I spoke, I shared this tax strategies presentation, this sheet. And what I did was I talked about strategy, description, whether you have to be a GP or an LP, right? GP means you're the ones putting the deal together. like Dawn has, or like some of you have, right? But if you're looking at what Anita is doing on the syndication side, that's an LP. And then over here, I also put offsets what kind of income. And if you look towards the bottom of the sheet, right, there's a bunch of strategies here that offset both passive and active income. And the active income is really what I think a lot of W2 people are looking for. So, just some resources you guys can take a look at. Okay, so in terms of sponsors and what we look for, for investment, it's pretty normal, right? What everybody's gone through: tax benefits, the returns, how long does it take first distribution, what the internal rate of return is, liquidity whole period. Is this a evergreen? Like I invested in an investment 10 years ago, and I can't figure out how to get out of it, right? There's no exit strategy because it's completely illiquid. So I'm going to be filing a REIT. I'm going to be filing a tax return on this forever because there is no exit strategy. And had I known that, I probably wouldn't have done it, or would have done it through an IRA or something. I'm looking at the investment thesis, right, to figure out, what do I believe what the sponsor is saying. I'm looking at cable and complexity. And then if the investment does not have tax benefits, I will usually invest in it through a IRA, right, like a self-directed IRA. But if it does have tax benefits, then it doesn't make any sense, right, to invest in an IRA. Then you want to go through a post-tax type bank account. In a sponsor, right, I'm looking for things like projected versus actual performance, assets under management references, and this one, tenure, right? And this is something which I would encourage everybody to really think about, right? Because we're in this club, we're seeing a bunch of people come in, and a lot of them don't have much tenure. And I made the mistake of investing in equipment with one person that came into this club which didn't have much tenure, right? And
what's a tenure?
Tenure is just like how long they've been in the place, how long they've been providing investments, and how well they've done, right? So if somebody comes in saying, "Oh, I've got 2 years of experience," well, that might not be enough because the last 2 years, 2020, 2021 was great. Everybody looked like a genius. So that's something which I would definitely look at. And then where I look for investments, personally, I use podcasts for knowledge, but not investing, because look, if you're new and you're starting off, right, I can see where podcasts are a really good place to go build your investor base. But if you're experienced, right, you shouldn't have to go to a podcast, right? You should just be everyone should be word of mouth, where the investors are coming in and reinvesting, or they're recommending other people to invest with you. So we've had several speakers in the last couple of months where I was frankly concerned, right? I was like, there's no way I'm going to give this person a penny. And the reason I'm bringing this up is just because, you hear a speaker as part of this club, don't assume anybody's vetted them, right? Because, I haven't, I don't, Daniel, you haven't. Vetting somebody can take weeks, months, and we simply can't. So you please make absolutely sure that the people
I'll explicitly state that, I definitely have not invested with all the people that are in here. And these are people that I've found that speak well, but it's, up to you to do your own due diligence.
Yeah. So assume, the base assumption is they're not vetted, right? And then, with investments, right? Guilty until proven innocent, right? You want to go the other way. And here's an example, right? So this is a speaker that came into our club, and they had this private equity consumer credit fund, just paying 1% a year. And I logged in a couple of days ago to see what was going on, and this person has pulled all the documentation from a previous offering. And in my view, that's a big no-no, right? You do not do that, right? Because for me, that's like extremely suspicious. The other thing I want to talk about is phishing. And I want to share some new information I've learned the last few weeks. Everybody, if you're working at a big company, right, you get trained on phishing all the time. And we're like, oh, phishing, I got it, right? So I actually went through my own mail the last day, and I pulled some examples, right? So here's one. Congratulations, you're approved to be excluded from paying from the IRS. Obviously, this is a phish, delete, right? This is an easy one. Here's another one, right? I'm getting an email from Microsoft saying unusual sign-in activity. It actually looks fairly legit. right? But if you look at the email, right, accounts-security.com, well, pretty sure Microsoft wouldn't have an email address that says that, right? So that's delete. But it's getting scarier. So here is, I'll let you guys read this. For those of you who use ChatGPT 4, right? ChatGPT 4 is phenomenally good at writing like a human does, right? So in this case, the prompt was write a short email in the voice of Elon Musk, requiring employees to install a Tesla-specific Zoom app, right? And then this is what ChatGPT came up with. So for those of you who've seen these sort of broken English, right? Pretty sure Netflix, when they're emailing me saying, "Oh, your passwords, you need to re-enter your password," they wouldn't know how to spell subscription properly. Well, it's going to change, right? Where the scammers are going to go figure out how to use ChatGPT, and then, but what's happening now is they are now logging in. They're basically hacking into people's email addresses. Let's say they hack into Daniel's email address. And then they'll basically figure out how Daniel writes. And then they send you an email saying, "Oh, from Daniel," right? Saying, "Hey, send, your account is ready to fund, right? Or I need some additional information from you, click over here to do it." And for those of you who don't think this is possible, this happens, right? Here's an example I got a couple of weeks ago from a sponsor that was at the Alternative Investment Club saying, they were the victim of spear phishing, and this sponsor, this is a professional organization that's wired $2.5 million to a fictitious vendor, right? That was made to look like their vendor. So I was in the bank a couple of weeks ago, and the bank manager, a friend of mine, was saying it used to be where people would wire 100,000, 200,000, these down payments, right, on their houses to fictitious accounts because somehow they gotten hacked. But now they're seeing title companies are wiring to wrong accounts because the title company, whoever it's sending it to, got hacked, and they're sending emails out. So this is a big concern, you guys, right? So when you do find a syndicate or a sponsor and you're going to wire the money, I wouldn't rely on email, right? I would basically rely on most of them use like a CrowdStreet portal, or they'll use a Juniper Space portal, right? One of these professional portals, and make sure you log into your portal and make sure the document is over there, because that's a lot more difficult, right? To go
Ashish, I would note that I've also seen this happening over Facebook as well.
Yes.
Oh, right.
Quite a bit. Somebody's account gets hacked, they start sending out messages, and I've seen syndicators have this problem as well there.
Yeah. So phishing is about to get a lot scarier, right? It used to be like, it's kind of a joke, like, haha. This is going to get much, much scarier. So when you do fund your account, right, double check. What I do is I physically call the sponsor and verify. And they get tired of the called, but I don't care, right? I'm going to make sure the sponsor is right, because before I send them $45,000 or $100,000. Any questions on this? Yeah. Okay, cool. I also had a bunch of examples for sponsors, but I don't think we have time. So I will stop and see if somebody else wants to share.
Well, I did have a question. You mentioned for new people coming into this, and Daniel mentioned podcasts earlier, but do you have any recommendations on podcasts, Ashish?
Yeah, so I actually listen to this guy called Buck Joffrey not very often, just to learn. And this is a retired doc, right, that has some really good speakers coming. And he doesn't, he's like me, right? He doesn't have a fund. He's not trying to raise money, right? So there's some good stuff there. And then in terms of, I've got a pretty big deal flow. I'll probably get 10 to 20 deals a week sent to me by sponsors I've worked with who I trust. So those are the people I typically rely on. But someone like Tim Shear, right? For those of you who haven't met Tim Shear, I would go back and look at that recording from Tim. Tim is phenomenal, right? He actually does a due diligence, and he's actually going out and looking for sponsors. So if you're looking for syndicates, right, maybe work with somebody like that.
And the link for the Excel I think somebody asked in the chat. I don't know if you can drop the link for the.
I'll drop it in there.
Okay, thank you.
All right, and thanks for the really good advice, Ashish. That was great advice, and it is you have to be aware of who you're dealing with. I love your advice of calling the sponsor on the phone and verifying it. Misi,
Yeah,
you're up.
Yeah, thank you. I know I just have a few minutes.
Sorry,
so
you've
I'll
got
try to
yeah,
be
you've got
brief.
5 minutes.
No worries. So Missy here, I actually don't work for Intel, but Daniel invited me to be part of the club. I guess it's been maybe almost 2 years now. My background is that I started investing by house hacking in 2019. And then I tried to scale from there with duplex, etc. But then realized tenants and toilets issues. That's when I started getting into passive investing. And I actually invested my first deal with Daniel, and I worked for Walmart as well. And with inspirations with Daniel, I started a club at Walmart as well. Have a little over 1,000 members since I started. And then throughout the process, I also started helping others to invest passively as well, given my data analytics background. So I've been always very big into due diligence and things like that in the process. What I realized, kind of going with a few of the speakers, what they shared, because unlike the stock market, even with stock market, even when you have audit companies, etc., there's so much potential issues that could be happening with each company that's not maybe audited, etc. But with private equity, it can be a lot more hairier. So some of the things I'm trying to do in my company and when I work with investors with my own funds is trying to find more standardized ways to do due diligence. And really, when I work with sponsors, work with other fund managers as well, I try to have bigger leverage of driving more consistency in reporting as well. So I don't know if you guys ever used a Better Mortgage as a mortgage company. So essentially, a lot of times when people buy their first home, they feel like the process of selecting lender is really overwhelming. So I feel like that process is similar to people who are first time passive investing because they don't really know what some of the terminologies mean. Like a good example is Glenn talking about the pref return. That's not really like you're not getting that on year one a lot of times if it's a value add, etc. So my learning is that always try to look for ways to standardize across different deals, whether it's multifamily, self-storage, etc. There are just so many investment metrics and return metrics, but what to look for that are similar. So try to find ways to standardize that. That's part of the things I'm working on with the next fund we're launching, more focusing on capital preservation and predictable income stream as well. So through my learnings, I try to figure out ways to standardize and help others see that as well, whether they're doing their own deals or doing other deals. I just want to thank Daniel for always being so growth-minded, whether it's through this club, always keeping it open, or helping me start my club. So I did want to come out here and say that, and continue to grow from here. Like a lot of the speakers shared, it's going to be a process, and just continue to learn from there and try to find ways to standardize. I think from the past 5 deals we worked on, and also talking with quite a few of the investors we had, it's the standardization that usually holds people back and makes that mistakes in investments.
All right. Thank you very much for sharing, Misi. I actually had a couple of people who wanted to share, but they couldn't share today. And so I'm going to extend this invitation out. If you are somebody that was inspired about something you heard here, or if you just want to share your story, we're going to do this again. So maybe we'll do it in about a month's time. We'll bring in a few speakers and try this again. So if you're interested in sharing your story, send me an email. I will get you into the agenda. And thank you to all of our speakers who are here. Hey, let's just take ourselves off mute and thank the speakers that came in today, everybody who spoke here.
Thank you very much. Thank you.
Thank
guys.
you.
Thank you.
Thank you.
That,
Thanks everybody.
Thanks, all.
Great job.
that's
Thank you.
Ryan,
Nice job, guys.
Anita,
Thank you.
Glenn,
Thank you.
Don, Ashish, and Misi. Thank you.
Thank you.
Have a wonderful Memorial Day, everyone.
You too, Daniel.
You too, Dan.
Thank you.
Thanks, folks.
Bye-bye.
Guys.